close your eyes. Between 2020 and 2022, two companies called Voyager Digital and BlockFi offered ordinary Americans up to 12% annual yield on crypto savings accounts, advertised on sports broadcasts, backed by institutional investors, promoted by celebrities. Hundreds of thousands of people deposited their savings. When Three Arrows Capital defaulted on a $650 million loan in June 2022, and FTX collapsed in November, both platforms froze. The savings accounts were not savings accounts. Imagine earning 12% annually on your savings. Not 12% from a speculative investment where you might lose everything. Not 12% from a hedge fund accessible only to accredited investors with minimum deposits in the millions. 12% from what looked like a bank account, a platform where you deposited your dollars and your cryptocurrency, and the platform paid you interest automatically every week. The money was yours. You could see your balance. You could withdraw when you wanted, or so the interface suggested. The platform was professionally run, publicly prominent, backed by well-known investors, and advertised on mainstream media. It was not obvious that anything was wrong. This was the promise that Voyager Digital and BlockFi made to hundreds of thousands of ordinary investors between 2019 and 2022. Not sophisticated DeFi users who understood flash loans and smart contract risk. Not institutional traders who accepted that their capital was at risk in exchange for high returns. Ordinary people, retirees who had heard about crypto yield and wanted more than their savings accounts offered. Young professionals parking emergency funds somewhere that would outpace inflation. Parents saving for college in accounts that seemed almost as safe as a bank. People who, when they read the fine print, if they read the fine print, would have found language saying that their deposits were not FDIC insured, that the platform was not a bank, that their assets could be used by the company for its own purposes. But who, given the professional presentation and the mainstream endorsements, might reasonably have believed that the fine print was protective boilerplate rather than a distinct warning about what was actually happening to their money. In the years 2020 and 2021, when crypto prices were rising dramatically and interest rates in traditional finance were near historic lows, the combination of yield and accessibility that these platforms offered seemed to resolve a problem that had long frustrated ordinary savers. Bank savings accounts paid effectively nothing. CDs offered slightly more but locked up your money. Bond funds required knowledge and minimums. And then here were these professionally packaged crypto platforms, offering yield that would have seemed like fantasy returns a decade earlier, and doing so through interfaces indistinguishable from the fintech apps that an entire generation of consumers had already normalized as their primary banking experience. The aesthetic was familiar. The returns were extraordinary. The risk was invisible. The marketing was sophisticated and demographically targeted. Voyager's advertising appeared in the kinds of media that financially active adults consumed: sports broadcasts, financial podcasts, mainstream financial news sites. The brand's sports sponsorships, including a naming rights deal for a Formula One venue and partnerships with the Dallas Mavericks, positioned it alongside institutional credibility markers that consumers had learned, through decades of advertising, to associate with financial stability. BlockFi ran advertisements that appeared in the same media landscape and used language that deliberately echoed the language of traditional banking, while technically maintaining the legal distinctions that protected the company from the obligations that actual banks carry. The aggregate effect of this marketing across both platforms and the broader crypto lending category was to create a significant consumer expectation of institutional safety that the underlying businesses were not equipped to deliver. When FTX collapsed in November 2022, it did not collapse alone. It collapsed as the center of a web of financial relationships that it had carefully constructed with numerous other crypto lending platforms. And when FTX fell, it pulled several of those platforms down with it. The most prominent were Voyager Digital and BlockFi, two companies that had staked their business models on crypto yield products aimed at retail investors, had extended enormous credit to FTX's trading arm, and found themselves unable to honor their customers' withdrawal requests when FTX froze withdrawals and then filed for bankruptcy. But the story of Voyager and BlockFi did not begin with FTX. It began with the business model itself, with the gap between what was promised and what was built, and with a different crisis that struck first. The story also involves a particular moment in the development of the crypto industry when the combination of easy money, rising asset prices, and underdeveloped regulatory oversight created conditions that allowed products to be marketed to retail investors in ways that no subsequent regulatory environment would permit. The crypto bull market of 2020 and 2021 attracted capital and customers at a pace that exceeded the pace at which protective infrastructure could be built. The companies that were built in that environment were built for the conditions of that environment. Conditions of rising prices, easy credit, and investor confidence that made the fundamental risks of the business model invisible. When the conditions changed, the underlying risks became visible all at once, and hundreds of thousands of people discovered simultaneously that the product they had trusted was not the product they had been sold. The human cost of this discovery was distributed unevenly. Customers who had deposited small amounts and who had other financial resources experienced the loss as painful but survivable, an expensive lesson, a chapter in their financial education, a reason to be more careful with the next platform they tried. Customers who had deposited large fractions of their accessible savings, or who had been living in part on the interest payments these platforms generated, or who had deposited money they had intended to use for precise purposes in the near term, for a down payment, for a medical bill, for a parent's care, experienced the loss as something closer to catastrophe. The same product, the same promise, the same failure, but the consequences varied by factor of many across different customers' lives. The aggregate loss figure of several $billion is accurate and is also a profoundly incomplete account of what happened. In the next chapter, what Voyager and BlockFi actually were. Not banks, but crypto lending platforms, built on a model that paid retail depositors high yields by lending their funds to leveraged hedge funds, in an environment where no regulation required them to explain that distinction clearly. Voyager Digital and BlockFi operated on similar models, but had different histories, different cultures, and different relationships to the larger crypto ecosystem. Understanding both requires understanding what cryptocurrency lending was supposed to be and what it actually became. The business model was straightforward in conception. Accept deposits from retail customers, pay them interest, and earn a spread by lending those deposits to institutional borrowers at higher rates. This is, in its essential form, banking, the same model that commercial banks have used for centuries. But the analogy to banking was exactly what made the yield numbers possible, and squarely what the marketing chose not to explain clearly. A bank that pays you 2% on your deposits earns that spread by lending your money out conservatively, holding capital reserves, and operating under regulatory oversight designed to limit the riskiness of its loans. A platform paying 12% was doing something different. It was lending to cryptocurrency, hedge funds, and trading firms at rates that those borrowers accepted because they believed they could generate returns large enough to cover them. Those borrowers were leveraged. They were concentrated in assets that moved together. They were paying high interest because no more conservative lender would extend them credit on the terms they needed. The 12% was not a technological innovation that made higher yields available without commensurate risk. It was the price of bearing a risk that was not adequately explained to the depositors who bore it. The difference was also legal and structural. Voyager and BlockFi were not banks. They were not regulated as banks. They did not have access to the federal deposit insurance that protects customers of banks up to $250,000 per account. They did not face the capital reserve requirements that regulators impose on banks to ensure they can honor withdrawals even in difficult conditions. They were crypto lending platforms operating under a regulatory framework that had not yet been designed for them. The question of whether their products constituted securities, requiring the kind of registration and disclosure that securities offerings demand, was contested between state and federal regulators for years before it was resolved. In the meantime, these platforms operated in a gap between the categories that existing regulation covered, presenting themselves to customers in ways that implied levels of safety that the regulation did not actually provide. BlockFi was founded in 2017 by Zach Prince and Flory Marquez, initially as a service that allowed cryptocurrency holders to borrow dollars against their crypto holdings without having to sell, a margin lending product for people who believed in the long-term value of their assets and wanted liquidity without triggering taxable events. The interest accounts, where retail depositors could earn yield on crypto holdings, were added later as a way to attract capital that could be deployed in the lending business. The model was straightforward. Raise capital from retail depositors at high interest rates relative to banks. Deploy that capital at even higher interest rates to institutional borrowers and capture the spread. The institutional borrowers were crypto hedge funds and trading firms with insatiable demand for capital. The retail depositors were ordinary people who wanted better returns than their banks offered. The platform sat in the middle, taking the spread, and for a period when credit was freely available and crypto markets were rising, the model worked. Voyager Digital had a different origin. It was founded in 2018, went public on the Toronto Stock Exchange in 2019, and positioned itself as a crypto brokerage and interest account platform for retail investors. Its CEO, Steve Ehrlich, was a veteran of finance and brokerage who brought credibility from traditional finance to a space that was still building its regulatory and reputational infrastructure. Voyager's publicly traded status gave it an additional layer of apparent legitimacy. Public companies have reporting requirements, auditors, and oversight that private startups do not. Both companies raised considerable venture capital in the 2020 and 2021 bull market. BlockFi raised more than $1 billion from investors, including Goldman Sachs' investment arm and the Singapore government's sovereign wealth fund. Voyager raised hundreds of millions of dollars and expanded rapidly, spending lavishly on marketing that included sports sponsorships and celebrity endorsements. The message was consistent across both platforms. Crypto yield, accessible, professional, safe. The marketing was effective. The underlying structure did not support the message. The institutional investors who funded BlockFi and Voyager conducted due diligence that, in retrospect, missed or accepted risks that would prove fatal. The venture capital firms and institutional investors who put money into these platforms were not unsophisticated. Some of them were among the most sophisticated financial institutions in the world. But the due diligence that institutional investors perform when evaluating a startup is oriented toward growth potential, team quality, and market size, not toward the concrete credit quality of the institutional borrowers whose ability to repay their loans would determine whether the retail depositors could get their money back. The question that mattered most: how creditworthy were the crypto hedge funds that were borrowing the retail deposits, was not the question that the institutional funding rounds were designed to answer. The funding rounds evaluated the platform businesses. The platform businesses depended on the credit quality of their institutional borrowers. That dependency was not the subject of the due diligence that provided the platforms with their apparent credibility. The particular chain of events that destroyed Voyager and BlockFi began not with FTX, but with Three Arrows Capital, the Singapore-based crypto hedge fund managed by Kyle Davies and Su Zhu that collapsed in June 2022, approximately 5 months before FTX's implosion. Three Arrows Capital, known in the industry as 3AC, had been one of the most prominent and apparently successful crypto hedge funds in the world. It had made early investments in crypto assets that had appreciated enormously, and its founders had cultivated a public image as thoughtful, sophisticated investors with genuine insight into the crypto market cycle. Su Zhu and Kyle Davies were regular participants in crypto conferences, prolific commentators on Twitter, and frequent subjects of favorable profiles in crypto media. They projected confidence, intellectual depth, and track records that commanded respect. The confidence was, it turned out, at least partly a performance. The track records were real, but the fund's current condition was not what the performance suggested. By early 2022, 3AC was managing assets estimated at anywhere from $3 billion to $18 billion, depending on the methodology used to value its concentrated and often illiquid positions. The fund had borrowed heavily from numerous crypto lending platforms, taking loans secured by crypto collateral and using the proceeds to make additional investments, a leverage strategy that worked as long as asset prices were rising and failed catastrophically when they fell. The scale of 3AC's borrowing was, it turned out, far larger than any single lender knew, because the fund had borrowed from multiple lenders simultaneously without disclosing the full extent of its obligations to any of them. Each lender had extended credit believing that 3AC's total liabilities were manageable. None of them knew that dozens of other lenders had made the same calculation based on the same incomplete information. The mechanics of 3AC's borrowing were an amplified version of the broader leverage problem that defined the 2021-2022 crypto market cycle. When asset prices are rising, leverage looks like intelligent risk management. You borrow against your existing assets, invest the proceeds, earn returns on both the original assets and the borrowed capital, and repay the loans from the returns. The cycle works as long as the assets appreciate or hold their value. When they decline, the logic reverses. The collateral value falls, lenders demand additional collateral or repayment, forced selling depresses prices further, the collateral falls further, and the cycle accelerates downward. For 3AC, the single trigger was the Terra Luna collapse, but the vulnerability was baked in from the beginning. A fund that had borrowed as extensively as 3AC was not equipped to survive any major sustained downturn. The Terra Luna collapse provided the downturn. The leverage did the rest. The collapse of Terra Luna in May 2022 was devastating to 3AC. The fund had significant exposure to Luna and to UST, the algorithmic stablecoin that Terra's ecosystem depended on. And when both assets went to essentially zero in the span of a few days, 3AC's balance sheet was irreparably damaged. The Terra Luna collapse was in itself one of the largest single destruction events in crypto history. Approximately $60 billion in market capitalization erased in less than a week, in a system that had attracted retail investors precisely because its stablecoin had seemed stable. For 3AC, the exposure went beyond the Luna and UST positions themselves. The fund had borrowed against these assets, had made leveraged bets on the stability of the Terra ecosystem, and had integrated Terra-related yield opportunities into its overall investment structure. When the foundation collapsed, the entire overlying structure came down with it. Voyager Digital had extended a loan of approximately $650 million to Three Arrows Capital, a loan that represented a substantial fraction of Voyager's total assets, and that had been made without the collateral requirements that would have been standard in any regulated lending environment. The terms under which this loan had been made were not fully disclosed in Voyager's public filings, and the concentration of risk that it represented, a single borrower accounting for a disproportionate share of a lender's assets, was not visible to the retail customers who had deposited their savings on the platform. Prudent banking regulation specifically prohibits this kind of concentration. Single borrower limits exist exactly because the failure of one large borrower should not be capable of destroying the entire institution. Voyager was not subject to those regulations. The loan that destroyed it was not illegal under the rules that applied to it. The unsecured nature of the 3AC loan deserves actual attention. In a secured loan, the borrower pledges collateral that the lender can seize if the borrower defaults, a mechanism that limits the lender's loss to the difference between the collateral's value and the amount owed. Voyager extended a loan of $650 million to 3AC without requiring adequate collateral. This meant that when 3AC defaulted, Voyager's recovery was not limited to the difference between collateral value and loan amount. It was zero or very close to it, because 3AC had no recoverable assets to satisfy its creditors. The loan was not the product of negligence in the narrow sense of an oversight. It was the product of a competitive environment in which crypto hedge funds demanded unsecured or under-collateralized credit because they had so many alternative lenders willing to provide it. Each lender who extended credit on favorable terms to 3AC was, in effect, competing with every other lender for the fee income that came from the relationship. The competition for the business drove the terms that ultimately made the default so damaging. When 3AC defaulted on this loan in June 2022, Voyager was left with a massive hole in its balance sheet. The platform did not have $650 million in reserve to cover this loss. It began to feel pressure on its ability to honor customer withdrawal requests, as customers, alarmed by news coverage of the 3AC collapse and its implications for lenders, began requesting their funds back in unusual volumes. BlockFi had also extended notable credit to Three Arrows Capital. The 3AC collapse created uncertainty about BlockFi's solvency that was only temporarily resolved by an emergency credit line from FTX, a lifeline that came with strings attached and that would prove 5 months later to be its own source of catastrophe. The summer of 2022 was, for the crypto lending sector, a season of cascading revelations. The collapse of 3AC had revealed that numerous lending platforms had extended credit to a single borrower far beyond what prudent risk management would have allowed. The platforms that had survived the 3AC collapse by a narrow margin, through emergency fundraising, through asset liquidations, through credit lines from better capitalized counterparties, found themselves in a weakened state that made them vulnerable to the next shock. Voyager Digital paused customer withdrawals in July 2022 and filed for bankruptcy shortly afterward. The announcement was structured in corporate language that attempted to convey orderliness and intention. Restructuring, voluntary reorganization, maximizing value for stakeholders. But its practical meaning was simple. Customers who had deposited money on the platform could not get it back. The funds were frozen, to be returned at some unknown future point in some unknown amount, subject to the outcomes of bankruptcy proceedings that would take months or years to resolve. The platform that had marketed itself as a safe, convenient place for everyday savings had become a locked vault with no firm date for reopening. For the customers whose funds were frozen, The bankruptcy announcement was the first clear signal that their understanding of the risk they had taken was incomplete. The platform's marketing had presented the interest accounts as accessible savings, money you could withdraw at any time, earning significantly more than a bank account. The fine print had disclosed that the accounts were not FDIC insured and that the platform could use customer assets in its operations, but these disclosures had not been presented in a way that made their implications clear to the retail investors who formed the majority of the customer base. The gap between how the product had been presented and what it actually was, an unsecured loan to a crypto lending company with significant exposure to a leveraged hedge fund, was the gap that swallowed customer savings. The customer base was diverse, and its losses were particular and human, in a way that aggregate statistics obscure. There were people who had moved their retirement savings to Voyager because the yield was dramatically better than anything available in their brokerage accounts. There were people who had parked emergency funds there because the interface was convenient and the rates were attractive. There were elderly investors who had been encouraged by adult children to diversify into crypto yield products. There were young investors who had treated Voyager as a savings account, parking their first meaningful savings in an account that seemed as safe as a bank and significantly more rewarding. None of them had understood or had been helped to understand that their money might one day be inaccessible for months or years. The freeze arrived without warning in people's lives. Someone would open the Voyager app on a Tuesday morning to check their balance and find that withdrawals had been paused. The balance was visible. The money was not accessible. The customer service phone line held long wait times. The website offered a brief statement about the company voluntarily pursuing restructuring to protect stakeholder value, a phrase whose full implications required legal understanding to decode. For customers who had scheduled bill payments, rent transfers, or other financial obligations against the assumption that those funds would be available, the pause created an immediate practical crisis that coexisted with the larger and slower-moving crisis of understanding what had happened and what would eventually happen to their savings. Financial stress and uncertainty about the future arrived simultaneously on a Tuesday morning through an app notification. In the bankruptcy creditor records, the individual claims tell stories that aggregate numbers obscure. A retired school teacher had moved $42,000 out of a CD account she had held for 20 years, drawn by the 12% yield and by the distinct assurance given in Voyager's marketing materials that her funds were held safely. She had chosen the product explicitly because it looked safer than buying crypto directly. She was not trying to speculate, she was trying to save, and the platform had presented itself as a savings tool. A software engineer had deposited his entire emergency fund, $60,000, because the platform's interface looked just like the fintech applications he already trusted, and because a sports sponsorship deal had registered in some part of his mind as institutional credibility. A couple in their mid-50s had moved a portion of their retirement savings at the suggestion of their adult son, who worked in technology and believed he was helping his parents access something better than a savings account. All three filed claims in the bankruptcy proceeding. All three waited for the process to resolve. The school teacher recovered something under 60 cents on the dollar. Enough to matter, not enough to be made whole. What is notable about these stories is how ordinary the decisions they represent were. The school teacher was not being reckless. Moving money from a CD to a higher yield product, even one outside the banking system, is a decision that financial advisors discuss with clients regularly. The software engineer was not being careless. Choosing a financial platform based on professional presentation and brand recognition is how most people make most financial decisions. The couple was not being irresponsible. Taking a trusted adult child's recommendation about a financial product is a normal way for people who feel less confident about an unfamiliar space to navigate that space. The decisions were normal. The outcome was not. The gap between the normalcy of the decisions and the severity of the outcome is the true measure of how far the platform's presentations departed from the actual nature of the risks their customers were taking. Sam Bankman-Fried positioned himself in the summer of 2022 as the savior of the distressed crypto lending sector. His firm FTX and its associated trading arm Alameda Research extended credit lines and made acquisition proposals to several struggling platforms, including Voyager. He appeared on mainstream financial media discussing the need for well-capitalized actors to step in and prevent contagion in the crypto lending space. He used the language of a financial statesman, concerned about systemic risk, willing to use his resources in service of the broader ecosystem's health. The interviews were widely covered. The positioning was effective. The reality of his offer to Voyager was considerably less heroic than the public presentation. FTX offered a $280 million credit line to Voyager, less than half of what 3AC had borrowed and not returned, in exchange for terms that would have given FTX considerable influence over Voyager's assets and operations in the event of a default. Voyager's board rejected the initial offer, finding the terms too favorable to FTX, and the companies failed to reach an agreement before Voyager's bankruptcy filing. What SBF was doing in these negotiations was not primarily protecting the ecosystem. He was identifying distressed assets and attempting to acquire them at prices that reflected their crisis valuation rather than their pre-crisis value. The White Knight framing was a public positioning strategy. The underlying negotiation was an opportunistic acquisition attempt by a firm that was itself less solvent than it appeared. BlockFi's relationship with FTX was more extensive and more damaging. FTX had provided a credit line to BlockFi in July 2022 that helped BlockFi avoid the immediate insolvency that had taken Voyager. The credit line came with an option for FTX to acquire BlockFi at a price as low as $25 million, a fraction of the company's prior valuation of $3 billion. These terms were painful. BlockFi's investors, who had put in more than $1 billion, were looking at an acquisition price that would return almost nothing. But the alternative was immediate collapse, and the board accepted the terms as the lesser harm. The relationship was presented publicly as a rescue, with SBF as the hero providing liquidity to a distressed but fundamentally sound company. What was not disclosed publicly was the full set of conditions attached to the credit line, or the degree to which BlockFi had become financially dependent on FTX, not just for the credit line itself, but for the yield opportunities that BlockFi had begun using to support its own interest payments to depositors. BlockFi had moved significant customer assets to FTX, transferring funds to take advantage of yield opportunities available through the exchange, without explicitly disclosing to customers that their assets were being held on a third-party platform. The customers who had deposited funds on BlockFi, believing those funds were held in BlockFi's own custody, were in fact holding claims on assets that BlockFi had placed on FTX. When FTX collapsed in November 2022, BlockFi was immediately and catastrophically affected. The credit line was gone. The acquisition option was worthless, and BlockFi's customer assets were frozen in the FTX bankruptcy. BlockFi filed for bankruptcy on November 28, 2022, 17 days after FTX. The collapse of BlockFi was in one sense a direct consequence of the FTX collapse. The November filing would not have happened without the November FTX bankruptcy. But in a deeper sense, BlockFi's vulnerability had been created much earlier, in the business decisions that had made the company so dependent on the FTX credit line and the FTX yield opportunities that a single counterparty's failure could bring it down immediately. The dependence was not accidental. It was the product of a series of choices made in 2022, in which short-term survival had been prioritized over the structural independence that would have made long-term survival possible. For BlockFi's depositors, the week between November 11th and November 28th was a period of acute and highly visible uncertainty. BlockFi had paused withdrawals on November 11th, the same day FTX filed for bankruptcy, citing its exposure to FTX as the reason. For 17 days, its customers watched the company's communications carefully for any signal of what would happen to their funds. The communications were careful and corporate, designed to provide as much reassurance as the circumstances permitted, without making representations that could not be supported. Customers who had deposited believing their funds were held in BlockFi's custody were now reading statements about the company's FTX exposure and trying to calculate what that meant for their particular account balances. The uncertainty was its own harm, distinct from the eventual financial loss. 17 days of not knowing whether your savings would be returned, during which you could make no plans and take no action, was an experience that the eventual bankruptcy proceedings could compensate only in the most partial and indirect way. The bankruptcy cases of Voyager and BlockFi unfolded over many months, generating thousands of pages of court documents, numerous hearings, competing acquisition proposals, and a steady stream of revelations about how the companies had been managed. Voyager's bankruptcy attracted several acquisition proposals in the months after its filing. Mark Cuban, whose Dallas Mavericks had a sponsorship relationship with Voyager, expressed public interest in the company's assets. FTX, before its own collapse, proposed to acquire Voyager's assets, a proposal that Voyager's creditors initially approved in a court hearing, only for FTX to file for bankruptcy itself a month later, rendering the acquisition impossible. The spectacle of two bankrupt companies negotiating an acquisition, where one had planned to acquire the other's assets and was itself simultaneously insolvent, illustrated something essential about the interconnectedness of the 2022 crypto crisis. The rescuer and the rescued were collapsing together. Binance.US eventually reached an agreement to acquire Voyager's assets for a reported $1 billion. That deal also fell apart, with Binance.US citing a hostile regulatory environment that made completing the acquisition impractical. The precise reason given, regulatory hostility, reflected the reality that by 2023, federal regulators had become significantly more aggressive toward crypto exchanges, and Binance.US faced its own regulatory scrutiny that made a major acquisition in a distressed sector an impractical additional complication. After multiple failed acquisition attempts spanning more than a year of bankruptcy proceedings, Voyager liquidated its assets and distributed the proceeds to creditors. Customers eventually recovered approximately 50 to 70 cents on the dollar, a partial recovery that was better than zero, but represented significant permanent losses for those who had deposited at higher valuations. The recovery timeline stretched across years. Customers who had needed their emergency funds during the freeze were unable to access them. The partial dollar recovery did not compensate for the time during which the money was unavailable, or for the losses incurred by people who had been forced to take on debt or make other financial adjustments to cover expenses they had expected to be able to pay from their Voyager accounts. In bankruptcy proceedings, the time value of money is not compensable. A creditor who recovers 60 cents on the dollar 2 years later, having been unable to access those funds during that period, does not receive compensation for the use of the money that was withheld or for the costs incurred while waiting. The legal framework for recovery does not account for the full human cost of the freeze, only for the financial loss calculated at a concrete point in time. BlockFi's bankruptcy revealed the particular dimensions of its FTX exposure. Approximately $1 billion in assets had been placed with FTX, including funds that BlockFi had characterized to customers as held in its own custody. The revelation that customer funds had been placed on FTX without customers' knowledge or explicit consent was, to many customers, the most damaging detail of the proceedings. Not just a bad business decision, but a breach of the representations the company had made about how their assets would be managed. BlockFi's customers had trusted that their assets were held by the company they had chosen. They had not agreed to have their assets placed on a third platform without their knowledge. The disclosure of this practice in bankruptcy proceedings was the one particular moment at which many customers who had believed they were dealing with a poorly managed company began to understand they might have been dealing with something more deliberately misleading. The BlockFi bankruptcy proceedings also revealed the actual terms of the FTX credit agreement, which had given FTX an option to acquire BlockFi at a price as low as $25 million. The extreme terms of this agreement, entered into under duress, reflected both the severity of BlockFi's situation in the summer of 2022 and the extent to which SBF had used the distress of the broader lending sector to negotiate arrangements highly favorable to FTX. BlockFi's creditors, examining these terms in the context of the bankruptcy proceedings, found a company that had traded considerable control over its future for short-term survival and had ultimately gotten neither survival nor control. The credit line had bought approximately 4 months before the FTX collapse ended BlockFi anyway. The BlockFi bankruptcy estate pursued claims against FTX to recover the assets that had been placed on the exchange and were now frozen. These claims were part of the larger FTX bankruptcy proceedings, which themselves involved billions of dollars in competing claims from dozens of major creditors. BlockFi's position as a major FTX creditor placed it in the peculiar position of being both a bankruptcy estate trying to recover assets for its own creditors and a creditor in another bankruptcy estate, competing with other creditors for distributions from assets that may or may not have been fully recoverable. The legal complexity of this situation, 2 major bankruptcy proceedings with substantial overlapping claims running simultaneously in different courts, illustrated something about the degree to which the 2022 crypto crisis had been a systemic event rather than a series of isolated failures. The failures were connected. The remedies were connected. The resolution required untangling a web of obligations that took years and major legal resources to address. The failures of Voyager and BlockFi triggered a regulatory response that had been building for years, and that their collapses dramatically accelerated. State securities regulators in multiple jurisdictions, led by New Jersey, where BlockFi was headquartered, had been investigating whether the interest account products offered by crypto lending platforms constituted unregistered securities offerings, requiring the kinds of disclosures and investor protections that registered securities carry. BlockFi reached a settlement with the SEC in February 2022, before its eventual collapse, agreeing to pay $100 million in penalties and to register its interest account product as a security going forward. The settlement was significant as a regulatory precedent. It established that yield-bearing crypto accounts could constitute securities under existing law, and that companies offering them without registration were in violation. The $100 million penalty was substantial, but the settlement did not prevent the company's subsequent failure. The regulatory finding that the product was a security did not address the underlying business model problems that would become fatal when the credit market turned. Compliance with securities law could have made BlockFi's products more transparent to investors. It could not have made 3AC creditworthy or prevented FTX from collapsing. The broader regulatory response to the crypto lending sector collapse included accelerated attention to which crypto products constituted securities, what disclosures needed to be made to retail customers, and what capital and operational standards should apply to platforms accepting customer deposits. The bipartisan outrage in Congress at the loss of retail investors' savings drove legislative discussions that had previously been stalled by disagreements about jurisdictional authority between the SEC and the CFTC. The particular harm to ordinary Americans that Voyager and BlockFi had caused gave regulators political justification for more aggressive action than they had previously taken. Regulatory officials who had been cautious about extending oversight to crypto products found that the public and political pressure created by the 2022 collapses had shifted the landscape significantly. The jurisdictional battles between the SEC and the CFTC over crypto regulation were a genuine obstacle to protective regulation, and the Voyager and BlockFi cases illuminated why. Crypto lending products that paid interest on deposited assets bore strong resemblance to securities under the Howey test, the legal standard for determining what constitutes an investment contract. If they were securities, the SEC had jurisdiction and could require registration and disclosure. If they were something else, commodities, currency instruments, loan products, the CFTC might have jurisdiction instead. The platforms themselves argued that their products were not securities, primarily because that characterization would impose registration requirements and disclosure obligations they preferred to avoid. The SEC took the position that they were securities. The courts and regulators working through the question produced inconsistent results across different platforms and different product structures. In the meantime, retail investors were depositing billions of dollars into products whose regulatory status was contested, in an environment where the uncertainty itself was part of the protection problem. Criminal investigations followed. Steve Ehrlich, Voyager's CEO, was charged with fraud by the Department of Justice and the Commodity Futures Trading Commission in October 2023, with allegations that he had made misleading statements to customers about the safety and FDIC-insured status of Voyager accounts. The charges carried the distinct personal accountability that class action lawsuits and regulatory settlements did not. The allegation that the people who ran these companies were not merely negligent, but had actively misrepresented the nature of the risks their customers were taking. The marketing that had made Voyager's interest accounts seem like safe bank accounts was not, in the government's view, merely aggressive promotion. It was fraud. Those claims that Voyager accounts were FDIC insured, language that appeared in certain marketing materials and communications, were false, knowingly false, and specifically harmful to the retail investors who had relied on them when making deposit decisions. The regulatory responses to the crypto lending collapse collectively produced a framework that did not exist before. Clearer rules about when yield-bearing crypto products require securities registration, clearer prohibitions on misleading representations about insurance and custody, and clearer expectations about the capital and operational standards that platforms accepting retail deposits must meet. These rules were imperfect and incomplete. Regulators and legislators disagreed about how to apply them. But the framework that emerged from the 2022 lending crisis was meaningfully more protective of retail investors than the framework that had existed before it. The retail investors who lost money in 2022 had contributed, through their losses, to a regulatory environment that would make it harder for the same losses to occur in the same way to a different group of investors in the future. That contribution was not a choice they made, but it is part of what their experience produced. The full picture of who lost money when Voyager and BlockFi collapsed is not available in any single document, but the bankruptcy filings contain enough detail to describe the general shape of the harm. Voyager had approximately 100,000 creditors, with claims ranging from small amounts to several $1,000,000. BlockFi had a similar scale of customer exposure. The aggregate losses across both platforms were in the range of several $1 billion. These are large numbers that belong to a genre of large numbers, billions of dollars, hundreds of thousands of people, that have a particular relationship to human experience. They are too large to fully comprehend and too small to feel from a distance, like anything other than statistics. The customers who bore these losses were, in many cases, exactly the demographic that consumer financial regulation is designed to protect. People without the resources or the sophistication to absorb large financial losses, who had trusted the professional presentation of these platforms and had not understood the precise risks they were taking. The fact that these risks were disclosed in legal boilerplate that few customers read carefully did not make the outcome less damaging. The disclosure was present, the understanding was absent, and the gap between the two was not entirely the customer's fault. It was also the product of a marketing strategy that systematically worked to close that gap in the wrong direction, presenting products in terms that minimized the appearance of risk in materials that customers actually read, while disclosing the risk in documents that customers typically did not. Consumer protection law in the United States has long recognized this asymmetry, the gap between formal disclosure and actual understanding, as a problem requiring regulatory response. Disclosures buried in terms of service agreements, written in legal language optimized for liability protection rather than comprehension, do not provide the kind of informed consent that meaningful protection requires. The FTC and CFPB have developed plain language disclosure requirements and deceptive advertising standards exactly because the formal presence of a disclosure does not guarantee that the person who needed the information received it in a form that allowed them make an informed decision. In the crypto lending context, the concrete misrepresentations about FDIC insurance were not buried in fine print. They appeared in prominent marketing materials, where they were designed to be seen and to be persuasive. The gap between the fine print disclosures and the prominent marketing claims was not ambiguous. It was the particular evidence that made the fraud charges possible. Some customers organized, creditor committees formed in each bankruptcy, with representatives working to maximize the recovery on behalf of the full creditor pool. Online communities of affected customers shared information, tracked the bankruptcy proceedings, coordinated to push for better outcomes, and documented the uneven ways they believed they had been misled. These communities served both practical and therapeutic functions. The shared experience of loss and the shared effort to understand it provided something that individuals navigating the bankruptcy process alone could not have. They also served as a visible reminder to regulators and legislators that the harm was not abstract. It was actual people, with particular names and distinct amounts, who had made reasonable decisions based on the information available to them, and had been let down by both the companies they trusted and the regulatory environment that should have protected them. The community that formed around Voyager creditors in Given was notable for its sustained engagement over a period of years. Members tracked every court filing, attended hearings in person when possible, coordinated to influence the selection of creditor committee representatives, and maintained detailed analyses of the competing acquisition proposals that the bankruptcy court considered. The level of engagement reflected the severity of the harm. For many creditors, the amount frozen represented a notable fraction of their financial assets, giving them strong motivation to invest substantial time in a process that most people hope never to encounter. Several creditors with professional backgrounds in finance and law contributed analysis that was valuable to the creditor committee's work. The community became, over time, an unusually capable collective of people who had learned bankruptcy law through necessity and who applied that knowledge in the service of maximizing recoveries for themselves and their fellow creditors. The partial recoveries that eventually emerged from the bankruptcy processes were real, but inadequate. Getting 60 cents back for every dollar lost is better than getting nothing, but it does not restore the retirement savings that were exhausted, the emergency funds that were needed during the months of the freeze, or the sense of trust in financial institutions that these experiences destroyed. The particular harm to precise people was real, and it did not have a financial remedy that made anyone whole. For people who had been planning retirements, saving for concrete near-term purposes, or relying on access to their savings during the freeze period, the gap between what they expected and what they received was measured not only in dollars but in plans unmade, debts accumulated, and a changed relationship with the financial institutions that would come after. The failures of Voyager and BlockFi taught lessons that the DeFi ecosystem, the regulatory community, and the retail investing public have absorbed with varying degrees of completeness. The first lesson is about yield. When a financial product offers significantly higher returns than comparable regulated products, the difference is almost always explained by a risk that is not fully visible from the outside. 12% annual yield on dollar deposits when bank savings accounts were offering near zero was not a technological innovation that made higher yields available without additional risk. It was a different risk profile, specifically the risk of lending to leveraged crypto hedge funds that were paying high interest rates because they needed leverage and could not get it elsewhere at lower rates. The yield was the price of that particular risk. Investors who accepted the yield without understanding the risk had made an incomplete bargain, even if the incompleteness was partly the company's fault. This lesson is ancient in finance and has been relearned in every cycle where interest rates are low and investment vehicles offering higher returns attract capital from people who need returns but cannot easily evaluate risk. The savings and loan crisis of the 1980s, the various money market fund crises over the decades, the structured product collapses of 2008, in each case, the same basic dynamic appeared. Investors reached for yield. The vehicles providing the yield were exposed to risks that were not visible or not fully understood, and when the risks materialized, the losses were distributed across the people who had needed the returns rather than the people who had structured the products. The crypto lending collapse of 2022 was a new instance of a very old pattern. The newness was in the technology and the regulatory gaps. The pattern was not new. The yield was not free. It was never free. The second lesson is about the gap between presentation and structure. Both Voyager and BlockFi used the visual language and operational conventions of consumer financial services, professional interfaces, branded debit cards, customer service teams, regulatory filings, in ways that communicated a level of safety and institutional solidity that their actual regulatory status and capital structures did not support. The gap between what these companies looked like and what they were was the space in which hundreds of thousands of customers were misled, some through deliberate misrepresentation, and some through the natural human tendency to treat sophisticated-seeming presentation as evidence of sophisticated-level protection. A company that looks like a bank, advertises on television, sponsors professional sports teams, and employs hundreds of people in professionally designed offices, does not thereby become subject to the regulatory protections that actual banks carry. The appearance was real. The protection was not. The third lesson is about contagion. The crypto ecosystem of 2021 and early 2022 had constructed an enormous network of financial interdependencies, lending relationships, credit lines, collateral arrangements that were largely invisible to the retail customers who interacted with these platforms, and that concentrated the risk of any single major failure across a wide range of apparently unconnected institutions. When Terra Luna collapsed, it damaged 3AC, which damaged Voyager and others, which were then damaged further when FTX collapsed. The ordinary customer who chose Voyager because it seemed safe had no way to know that their safety depended on the stability of a leveraged hedge fund in Singapore, or on the honesty of a celebrity CEO in the Bahamas. They did not know because no one told them, and no one told them because the regulatory infrastructure that would have required disclosure did not yet exist. The interconnection was real. The disclosure was absent. The harm was distributed across hundreds of thousands of people who had no visibility into the network they had unknowingly joined. There is a fourth lesson, quieter than the others, about the difference between the way financial risk looks from outside an organization and the way it is understood from inside. The executives at Voyager and BlockFi knew their balance sheets. They knew the size of their 3AC loans. They knew the terms of their FTX agreements. They made decisions that can be described as reckless or as negligent, or in some cases as deliberate misrepresentation, depending on any one decision and the actual evidence. But at the level of the individual employees, the customer service representatives who answered questions about safety, the marketing teams who designed the campaigns, the operations staff who processed deposits, these people were working for companies that appeared to be functioning normally. The distance between what the leadership knew and what the frontline employees knew was itself a kind of systemic risk. The people closest to the customers who were taking on risk were the people least equipped to warn those customers of the particular nature of that risk. Close your eyes again, if they have opened. Somewhere in the bankruptcy dockets of the Southern District of New York and the District of New Jersey, the names and the claim amounts of the people who lost money are recorded. Hundreds of thousands of entries in the court's creditor registers, each one representing a person who made a decision they believed was reasonable and whose belief proved to be wrong in ways they could not have anticipated from the information available to them. The records are public, the losses are permanent, the companies no longer exist. The money that was lost was real, the people who lost it were real. The promise that attracted them, that their savings could work harder for them, that the crypto revolution had created something new and better than what came before, was real in a way that made the loss feel like betrayal rather than merely bad luck. They had trusted, and the trust had been misplaced, and no legal proceeding or regulatory reform fully addresses what that means for the distinct people whose given savings are gone. The regulatory frameworks that have since been built will, if they work as designed, prevent the same loss from occurring in the same form. They will not return what was taken from the people who trusted too early, in a space that was not yet ready to deserve it. The particular phrase that Voyager used in its marketing, that customer accounts were FDIC insured, was false in the precise sense the FD insures deposits at banks, and Voyager was not a bank. The phrase was designed to provide reassurance that the regulatory framework could not honestly provide. When investigators examined this phrase in the context of fraud charges, they found a company that had known the statement was misleading and had used it anyway because it was effective. The customers who read that phrase and believed it had not been naive or careless. They had read a concrete factual claim, had no reason to disbelieve it, and had made a financial decision based on it. That the claim was false was not their failure, it was the company's. The fraud charges that followed from that particular misrepresentation represent the legal system's clearest effort to draw a line between the acceptable promotion of a financial product and the deliberate deception of the people who rely on it. Let the complexity of this rest tonight. The world's financial systems are imperfect, and the spaces at their edges are not always as safe as they appear. This is not a reason for despair. It is a reason for clarity. You are safe, you are still. Rest. Story end.